Most people believe the story of economics begins with Adam Smith or maybe Karl Marx. But almost nobody talks about the thinker who understood the dangers of money nearly 900 years earlier. And his warning might explain why modern financial systems keep collapsing. Because according to this medieval philosopher, economies don't fail because of numbers. They fail because of human behavior. And once you hear his theory, you might start seeing today's financial world very differently. Long before central banks, before stock markets, before modern capitalism even existed, there was a scholar named Al-Ghazali. He lived in the 11th century during what historians call the Islamic Golden Age. At the time, much of Europe was still economically fragmented and struggling to recover from the early Middle Ages. But across the Islamic world, cities like Baghdad, Damascus, and Cairo were thriving. Trade routes connected continents. Markets were full. Wealth was growing rapidly. But Al-Ghazali noticed something strange. The richer society became, the more unstable it seemed. People were accumulating wealth faster than they were developing wisdom, and that imbalance worried him. So he started asking a question that economists still struggle with today. What happens when a civilization becomes rich but loses its moral compass? To answer this, Al-Ghazali focused on something simple but powerful: money itself. He argued that most people misunderstand what money really is. According to him, money has no value on its own. It's just a tool, a mirror that reflects the value of the goods and services people exchange. Gold, silver, coins, they only matter because people trust them. Without that trust, money is just metal. But Al-Ghazali believes societies often forget this. Instead of using money as a tool, people begin to worship it. They hoard it. They chase it. They measure status and power by how much of it they control. And when that happens, the economy slowly begins to distort. One of his most famous ideas was surprisingly simple. Money that sits idle is harmful. If wealth is locked away in chests, buried underground, or hoarded by elites, it stops circulating. And when money stops circulating, the entire economy suffers. Businesses slow down. Workers lose opportunities. Trade shrinks. He described this as freezing the bloodstream of society. Think about that for a moment. Nearly 1,000 years ago, he was already describing a problem that modern economists still debate today: wealth concentration. But Al-Ghazali didn't stop there. He also warned about speculation. He criticized merchants who manipulated prices, created artificial scarcity, or exploited crises for profit. To him, speculation wasn't just clever strategy. It was a form of corruption, because profit without contribution weakens the system. Markets only function when people trust each other, when buyers trust sellers, when citizens trust institutions. And when that trust disappears, the entire economic structure becomes fragile. But perhaps his most controversial warning was about governments. Even in the medieval world, rulers often try to stretch their budgets by secretly reducing the gold or silver inside coins. In other words, they were creating inflation. Al-Ghazali condemned this practice completely. He argued that debasing currency was essentially stealing from the public, because people thought they were receiving real money, when in reality, its value had been quietly reduced. Sound familiar? Today, governments don't shave gold off coins anymore. But debates about inflation, currency manipulation, and central bank policies dominate global economics. And that's exactly what makes Al-Ghazali so fascinating. He understood something that many modern economic models overlook. Financial systems are not purely mathematical. They're psychological systems built on trust. Once people stop trusting the system collapses. History proves this over and over again. When people lose faith in their currency, they abandon it. When they lose faith in institutions, markets panic. When incentives reward manipulation instead of productivity, corruption spreads. And eventually the economy becomes unstable. Al-Ghazali believes societies can survive poverty, but they cannot survive corruption, because corruption destroys the invisible glue that holds markets together. Trust. Without trust, contracts mean nothing. Currencies mean nothing. Institutions mean nothing. And when that happens, even the richest nation can collapse. Now, look at the modern world. Rising wealth inequality, speculative bubbles, inflation fears, declining trust in institutions. These aren't new problems. They're the same patterns Al-Ghazali observed nearly 1,000 years ago, which raises an uncomfortable possibility. Maybe the real danger to financial systems isn't technology, or globalization, or even economic policy. Maybe the real danger is something far older. Human nature. Because when greed replaces responsibility, when speculation replaces contribution, and when money becomes detached from morality, even the most powerful economies become fragile. And that's the warning Al-Ghazali left us 900 years ago. The question is whether we're wise enough to listen. If you want to understand money, markets, and the hidden lessons of financial history, subscribe to the channel. Because the past often explains the future better than the news ever will.